The EV industry just absorbed over $65 billion in losses and write-downs in the last 12 months alone. Honda canceled their entire EV strategy. Ford lost $19 billion. Stellantis lost $27 billion. And 5 specific EV brands are right now in financial trouble, some of them with bankruptcy odds above 40%, according to prediction markets. By 2028, several of these brands may simply not exist anymore. Today on Nick's Car Review, I am breaking down the 5 EV brands at the highest risk of going out of business by 2028, and what it means for you if you are thinking about buying one of their cars. Let's get into it. Kicking off the list at number 5 is the EV brand that posted a $1 billion loss last year, Polestar. This is the all-electric brand owned by Geely, the Chinese automotive group that also controls Volvo. Polestar was positioned as a premium electric performance brand competing with Tesla, BMW, and Mercedes. And on paper, the cars themselves are genuinely well-engineered. The Polestar 2 has been quietly competitive in the luxury EV space. The Polestar 3 brought a luxury SUV into the lineup, and the Polestar 4 added a coupe-like SUV body style. But the financial story is grim. Polestar posted around $1 billion in losses recently, and the situation has only gotten harder. The US market has been particularly brutal for Polestar because the cars are imported from China and have been hit with massive tariffs that essentially eliminate any pricing competitiveness in America. Sales here have collapsed. The brand has tried to shift production to Volvo's South Carolina factory to dodge tariffs, but the move has been slow and expensive. The bigger issue is that Polestar is sandwiched in a competitive space where it does not have a clear identity. Tesla owns the EV-first mainstream luxury segment. BMW and Mercedes own the traditional luxury electric space. Lucid owns the premium engineering halo. Polestar sits in the middle without a strong reason for buyers to choose them over those alternatives. Their European market has been their lifeline. But as European EV growth slows and competition intensifies from Chinese brands like BYD, even that safe harbor is shrinking. Polestar still has Geely backing them financially, but if the losses continue at this rate, even a wealthy parent company has limits. The brand needs a turnaround story. Soon or by 2028, the question of whether Polestar still exists as an independent operation in America becomes very real. Number 4 is not a single brand, but a group of brands all owned by the same struggling parent company. The Stellantis EV brands, specifically Fiat, Alfa Romeo, and Maserati on the electric side. And to understand why this entire group of brands is at risk, you have to understand what Stellantis is going through right now as a whole. Stellantis recorded the largest single EV write-down in the entire automotive industry. $27 billion in losses tied directly to their EV divisions in the second half of 2025 alone. To put that number in perspective, that is more than the entire annual revenue of most automakers. Stellantis effectively admitted that their bet on going all electric across all their brands was a financial disaster. They have been canceling EV programs, delaying launches, and pivoting back to gas and hybrid vehicles as fast as they possibly can. The brands within Stellantis that are most at risk are the smaller electrified ones. The Fiat 500e has been a sales disaster in America, with monthly numbers in the low hundreds. The Maserati Grecale Folgore and Gran Turismo Folgore EVs have been similarly underwhelming, with the brand reportedly considering pulling out of the EV space entirely. Alfa Romeo's electric Giulia has been delayed multiple times, with the brand itself facing existential questions about whether it has a future as a luxury automaker. Even Chrysler and Dodge's electric ambitions have been scaled back dramatically. The Dodge Charger Daytona EV has been a sales disaster, with massive incentives needed just to move inventory. Stellantis CEO Carlos Tavares was forced out, partly because of the EV strategy disaster. The new leadership team has openly stated that some Stellantis brands may not survive the next few years. By 2028, it is genuinely possible that Fiat, Alfa Romeo, or Maserati no longer exists as a viable brand in America, and several of their electric programs are likely to be canceled outright. If you are considering buying any new EV from any Stellantis-owned brand, that is real risk you need to factor into the decision. Number 3 is the Vietnamese EV maker that arrived in America with massive ambitions and has spent the last 2 years quietly fading away. VinFast. Backed by one of the largest conglomerates in Vietnam, VinFast launched in America with the VF8 crossover and a promise to disrupt the entire affordable EV market. The reality has been much harsher. The VF8 received some of the worst initial reviews of any new vehicle in recent memory. Reviewers criticized the handling, the build quality, the software, and basically every aspect of the driving experience. The interior felt rushed and underbaked. The throttle calibration was so problematic that some reviewers called it dangerous. And the original launch pricing in the $50,000 to $55,000 range was simply not competitive with established brands. VinFast has tried everything to turn the situation around. They dropped pricing dramatically. The VF8 now starts closer to $40,000 new, with used examples selling for under $20,000. They offer an absolutely incredible 10-year warranty across the entire car, including the battery with unlimited mileage. They have aggressive lease deals that make the cars attainable on paper, and they have been quietly trying to build a service network across the US. But the sales numbers tell the real story. VinFast has been moving only hundreds of vehicles per month in America. Their stock has collapsed dramatically since going public. The Vietnamese parent company has been propping up the brand with billions of dollars in support, but even a wealthy parent has limits. By 2028, the question is whether VinFast will still be selling cars in America at all, or whether they will quietly retreat back to Asian markets where they have better positioning. For American buyers, that uncertainty is a real concern when you are betting that the company will be around to support your vehicle for the next decade. Number 2 is going to be controversial because the company makes some of the most genuinely beloved electric vehicles in America, Rivian. The R1T and R1S are legitimate cult favorites. The new R2 just launched to enthusiastic reviews. The interior design, the software experience, the off-road capability, and the overall brand identity are all genuinely best in class. Rivian fans are some of the most passionate owners in the entire EV space. But the financial reality is genuinely concerning. Prediction markets right now assign roughly a 48% probability that Rivian will announce bankruptcy before the end of 2026. 48%. That is essentially a coin flip on whether one of the most exciting EV brands in America survives the next 18 months as an independent operation. Rivian holds around $3.5 billion in cash, but they are burning through roughly $2.5 billion per year in free cash flow, plus another $2 billion in capital expenditures planned for 2026. Do the math and the runway gets very short very quickly. Rivian has a few lifelines. The joint venture with Volkswagen Group brings up to $5.8 billion in investment over time, which buys real time. There's also a Department of Energy loan worth up to $6.6 billion helping fund the Georgia factory expansion. And the R2 launch is the most important volume catalyst the company has if it succeeds at scale. Rivian's economics improve dramatically because they can spread fixed costs across more vehicles. The realistic scenario is not necessarily that Rivian disappears entirely. It is more likely that by 2028, Rivian gets absorbed into Volkswagen Group or another larger entity. The technology and brand stay, but Rivian, as an independent company, may not survive. For buyers, that means current Rivian owners are probably fine because warranty support continues even through ownership transitions. But the brand independence and the unique Rivian experience could look very different by 2028. And here we are, at number 1, the EV brand at the highest risk of going out of business by 2028, according to the actual financial data, Lucid Motors. And just like with Rivian, this might be a controversial pick because Lucid makes some of the most genuinely impressive electric vehicles ever built. The Lucid Air has 500 miles of range. The Lucid Gravity just won Luxury Car of the Year. The engineering is world-class. But the financial situation is even worse than Rivian's. Lucid has burned through around $18 billion in cumulative cash since inception, more than any other pure-play EV startup ever. And here is the truly alarming number in their most recent quarter. The cost of building each car was nearly double the revenue from selling each car. That means Lucid loses money on every single vehicle before counting any overhead costs at all. The economics are structurally inverted in a way that no other automaker on this list comes close to. Lucid's lifeline is Saudi Arabia's public investment fund, which has invested over $8 billion and continues to back the company. Without the PIF, Lucid would have run out of money years ago. The new Cosmos midsize SUV is supposed to launch in 2027 and bring Lucid into a higher volume market segment. The bet is that if Lucid can scale production to 50,000 or 100,000 units per year, the economics could finally improve. But prediction markets are skeptical. The current odds of Lucid declaring bankruptcy by end of 2026 sit around 42%, and that number gets worse for the longer 2028 timeline. The most likely outcomes are either continued Saudi rescue funding indefinitely, an acquisition by a larger automaker who wants the technology, or eventual liquidation. The technology will likely survive in some form. The Lucid brand, as an independent company, is genuinely uncertain. So there you have it, the 5 EV brands at the highest risk of going out of business by 2028. Polestar with $1 billion annual loss and a US tariff disaster. The Stellantis EV brands Fiat, Alfa Romeo, Maserati caught in a $27 billion write-down nightmare. VinFast quietly failing in America despite massive parent company support. Rivian burning $2.5 billion per year with prediction markets giving 48% bankruptcy odds. And Lucid sitting at number 1 with the worst economics of any major automaker on the planet right now. Here is the bigger picture for buyers. Just because a brand is in financial trouble does not mean buying one of their cars is automatically a mistake. Often, struggling automakers offer the most aggressive incentives, the best lease deals, and the lowest prices. If you find a Polestar, a Lucid, or a Rivian at a deeply discounted price, you might be getting incredible value. But you need to factor in real risks. Resale values typically collapse for at-risk brands. Warranty service could become harder to obtain if the company gets restructured. Parts availability and software updates could become unreliable. For the safest EV buying experience right now, the brands with the strongest financial foundations are Tesla, Toyota, Hyundai, Kia, BMW, Mercedes, and the major GM brands. Those are the companies that will definitely be supporting your vehicle in 10 years. For the brands on this list, the cars themselves might be incredible, but the brand support behind them is anything but guaranteed. I am Nick, this has been Nick's Car Review, and I will see you in the next one.